Hello, Paul Gerard from Price Accounting Services, and welcome to this video on trusts and key year-end tax issues in our business and entity channel. When we consider discretionary trusts that either produce investment income or business income, we should always consider some key tax issues which must be addressed for proper, effective tax outcomes. Many media commentators discuss trusts and raise concern that income splitting using trusts is a form of evasion. Trusts are a very old legal concept, however, which predates companies, which were a modern structure to address tax benefits. Surprising to many. However, the issues of income splitting and avoidance has typically been the scope of media and other concerns in recent times. Over time, many laws have evolved to address the key issue of evasion, allowing trust income to be earned by one party, for example, but another benefits from that. One key foundation of our trust tax laws is to ensure the trustee makes a valid choice to distribute income before 30 June of each year. If it doesn't do so, the highest rate of 45% applies. Another key foundation are laws which limit the use of losses and access to franking credits. Family trust elections may be required. Not all tax advisors are proficient in the operation of trusts. I've been very fortunate in my career to have worked for a very proficient advisory firm that specialised in trust structures, including discretionary trusts, SMSFs and other forms of trust. We trained and advised members of the accounting bodies, conducted seminars and advised on trust issues. We also worked with proficient barristers and solicitors to develop and finesse these products and their features. You notice I use the word products. At the end of the day, that's how we treated it. It's a product. It might be a legal concept, it may be a structure to some, but at the end of the day, it's a product that facilitates a tax outcome. So there's some key points. Trust must always account for assets, liabilities, income and expenses at all times. No trust should ever just prepare a tax return. If it does so, it places the entire nature and concept of being a trust completely at risk of being set aside. We don't accept, in our firm, tax return only engagements for trust matters for this very reason. Anybody who has a trust which does not produce a balance sheet and financial statements should seek immediate and urgent tax advice on the risks that this places them in. Second key point, trust resolutions and not minutes are essential. Why the distinction? Let me explain the legal concept between the difference between a minute and a resolution. A minute is a record of a meeting which occurred at a point and place in time and is a question of fact. A resolution, on the other hand, need not be at a particular place or time. It merely just needs to be a record of an agreement that was reached by those parties. It could be conducted with those parties in other cities, countries or locations where the meeting of the mind is via email or another means or method. So therefore, if you want to be attacked by the tax office and you claim to have minutes that say the meeting was held at a place and time and it didn't, you are at immediate risk in a court of law that you could be found to be creating a fiction. It is easier to have resolved and make a resolution. A resolution need not even be at the same point in time. It may merely record what has previously been agreed. This is a far safer strategy if a dispute arises. A third point, where trusts and related companies have loaned funds to beneficiaries and associates, it's critical to consider and have legal loan agreements and to continually maintain these loans and their accounting to comply with Division 7A of tax law and to show the movements on the loan account that can be supported and explained. Many times we see all concern given to an interest accounting entry to charge interest to claim as a tax deduction, yet the parties can't agree on how the debt was calculated. So it is better to ensure that your accounting is consistent, continued, and also supported so that every aspect of the loan is valid and agreed between the parties. And lastly, care must be taken with distributions. Recent ATO warnings in 2020 have revisited long-established tax law, i.e. these are not new rules, that frown on arrangements where one beneficiary may be made entitled, yet others benefit instead. Using a simple example, the trust distributes income to Stuart, the trustee's own 18-year-old son. Then Stuart doesn't receive the benefit of physical income at all. But through reimbursement arrangements, the funds end up in mum and dad's bank account. The ATO asks Stuart, so where did the money go? He says, I don't know. You've just placed the whole accounting, tax structure at risk that it's a sham. So these issues aren't simple, they are quite complex, but they don't need to be overly complex. That's the message I'd like to leave you with. Good advisors who know the practical treatment of trust strategies are vital if you're using a trust. A trust is not just a deed and a thing you do each year. You have to do it correctly. Distributions may need to be physically paid to avoid some concerns. In others, there may be grounds to set it aside and pay it later. Your advisor will or should know the correct approach and consider the risks you may have. If all those things are fine, then you should be fine. So what I guess we leave you with is be in good hands with good advisors and you shouldn't have problems. So I hope you found that helpful. Hope you found your trust issues which relate to your business or investment entity useful. And if you have any questions, we do welcome them at all times. We also would like to leave you with other videos in this channel concerning business arrangements and tax issues. So we hope you found it interesting, and for now we'll just leave it there and hope you watch another video later. Cheers.